I'm Scott. I've been at BiggerPockets for 10 years. I started my journey as the third employee at BiggerPockets, and I've been CEO for the last 6 or 7 years. So the last 3 years have been mostly a continuation of what I was doing previously. So I've kind of gotten into maybe a pattern, if you will, of just, working on the next thing at BiggerPockets, spending less than I earn, steadily accumulating more real estate and more index funds, and really kind of just continuing to do the things that I've always done while slowly expanding or improving, I would say, the quality of my lifestyle. So, if I was in my early 20s, really cutting costs and really trying to make sure that every dollar I could was going towards investments and building capital, I would say I'm starting to lighten up a little bit more in my 30s, and starting to enjoy some of the passive income that has been built up over all of this time as part of that as well. So those are the themes. Happy to get into the specifics if that would be helpful around any of those areas as well.
Yeah, and I know we'll spend a lot of our time talking about like through some technical real estate, economical things. But since you mentioned like that, you're kind of getting into this era of your life where you're getting to start to enjoy the fruits of your labor a little bit. For people who are on that path, like what are some examples of that? Like what are things that you have found? And I would think it'd be interesting to also talk about things maybe you thought you would want to like spend more money on, enjoy, but then once you actually started getting into it and spend the money, you're like, it's really not that, it's really not that great. Like how's that experience been getting to open up the pocketbook a little bit, and what are some of those actual things that you've been spending more money on?
Yeah, well, so it's kind of a double-edged answer to that. So first, some of the increase in spending comes from the fact that BiggerPockets has gotten a lot bigger, and I'm realizing that the demands on my time as CEO are very high. And so, whereas like I wouldn't have thought about ordering Uber Eats, for example, for lunch ever previously, now I'm like, you know what, I'm just going to do that. And so that's a much more frequent occurrence in my life because the time commitment to preparing a lunch or whatever is actually starting to eat into like it's almost like a bad economics decision unless I'm very efficient about it and plan ahead and really develop and hone that skill these days. Whereas that would have been a no brainer. I would never have ordered stuff in to eat at the level of frequency I do today, for example. We just bought a house. So I finally have my hopefully we'll see forever home, or for next several decades home that I want to raise our family in over the next couple of years. So that's really exciting, and that's a nice big home in a good area with good schools. And a couple of amenities there. I'm looking forward to getting a hot tub, for example, and a sauna, which I was surprised at how affordable saunas are. You can get them for like $2,000 in there. And I always like a good sweat. That's going to be my next book, by the way. Sweat for Life, a guide to fitness. It's April Fool's Day when we're recording this, and that was one of my jokes one year. So that's been one example. And then travel has been another big one. Even since 2021, I've probably gone on 35 different trips to various locations, either for work or pleasure, or sometimes a combination of the two. If there's a work trip, and can we turn it into a little bit of a vacation? So been all over the place and really enjoyed that quite a bit. Mostly continental United States and Mexico. So not major overseas trips on that front.
So you mentioned the personal home. Has your philosophy on real estate investing changed at all? I know before you were a very big proponent of the slow and steady approach. You're someone who you're very analytical. You look at the market, you make a purchase. I don't remember the exact frequency. It was something like you put in an offer every year or every other year, and you weren't super interested in growing a huge portfolio as quickly as possible. You're more the slow, methodical approach. Has that changed at all in the past couple of years?
No. So that continues to remain the core of it. And my philosophy that a house is not an investment has also not changed. So I'm not pretending like my primary residence that I just purchased is an investment. It is the luxury item that I am purchasing because of my investments in other areas. So that's nothing's changed there. I have a fairly lightly levered portfolio. If I was pursuing paths that other real estate investors have pursued in the last couple of years, I might have 100 or 200 units from there. I have 13 rental units that I manage here. I own and manage, and I have a property manager, but I manage the manager. With this, and I have a small amount in syndications where I'm probably going to lose my entire investment in those. So luckily, that's a very small portion of the portfolio. I just consistently buy in Denver properties that I can hold for the long term, and I will continue doing that. And my philosophy, that is it was painful with that philosophy, I would think, in 2021, especially because like you see all these folks racing past you in terms of wealth, building out these huge portfolios with dozens and hundreds of units. And now I'm like, some of those folks, especially the ones who moved into like multifamily and other commercial asset classes, are going to probably be in for a world of hurt at this point in time. So I'm, if anything, more convicted than ever in the slow and steady approach at this point.
Yeah, I think digging into that a little bit more, your approach, we talked about like if it's changed or not, and it really hasn't. But for people who are out there trying to invest, like you're so close to all this and seeing all these deals come across, like if you look back to when we had you on the show last time in May of 2021 versus today, what are the good deals looking like? Like how do they differ from what they looked like 3 years ago?
For me, not by that much, right? So they look like one difference is, I'll step back for a second here. What am I doing with a slow and steady approach? I'm making a 30-year bet on long-term appreciation in housing prices and rents in the metro area that I'm investing in, right? So I invest in Denver, Colorado. Is Denver, Colorado real estate going to be worth more or less, adjusted for inflation, in 30 years than it is today? My bet is that it will be worth more. We have constrictions on supply in the form of water. We don't have enough water here. We have plenty of land, but not enough water. And people want to live here because of our proximity to the mountains, because the city continues to improve, right? You can in this day and age, people can live anywhere they want, and many of them choose to live in Denver and work remotely for companies elsewhere, right? And that is a dynamic that I think will endure for many decades. We'll see if I'm right on that. But that means that the best investment is something that is going to be on the higher end of that long-term appreciation tail over the next 30 years, which means certain pockets of town that I've identified that have good prospects. Now, the other part of it is it's got a cash flow from day one, right? With reasonable capitalization. Well, if anything, I've gotten more conservative in my philosophy around real estate, and I use less debt around that. So when you use less debt and you put a bigger plop down more cash, it's actually easier to find cash flow in many of those areas. Now it hurts your returns and all those kinds of things because higher leverage does equate to higher returns, but that's a trade-off. Where I'm finding good opportunities in the long-term, boring, old-fashioned rental space is in units with more bedrooms. So like I have a duplex that I live in now. Actually, closing the house last week when we're recording this. I move in next week. And right now I live in one of my duplexes. It's a 4-bed, 3-bath on one side and a 5-bed, 3-bath on the other side. So big duplex. Well, I like that as a particular tactic right now and feel it's congruent with that long-term approach because those units will be in demand by a certain type of renter. And right now we're seeing a lot of new construction in small multifamily properties, right? So like 2-bed, 1-bath units, 1-bath units. We're not seeing a major increase in 4 and 5 bedroom rental stock going on in the area. And so I think that's been a fun, or not fun, a little niche that I think works very well with my strategy and just as a slight switch. Instead of buying a duplex with a bunch of 2-bed and 1-bath units, I can buy one with 9 or 10 total baths. And now I've got a different type of tenant, right? Somebody who the alternative to renting has really increased for people that are trying to buy a 4 or 5 bedroom home. And so that gives me a nice pool of renter applicants. So if anything, that's like my very subtle tactical shift. But if I found a great deal in the 2-bed, 1-bath space, I'll buy that. So I'm going into this next purchase, which I'll purchase by the end of the year. I'm set aside the cash capital for it, and we'll educate myself and try to make one calculated bet by the end of the year. And that will most likely, the first place I'm looking is in that large, small multifamily space. How'd I do there? Is that
large, small multifamily? Yes.
Yeah, large, small multifamily space. And that's where I think I'll find the opportunity, but I may also just find another opportunity that is, hey, here's a 5-plex that is all 2-bed, 1-bath units and happens to be a great deal. So we'll see how it goes.
Something I find really interesting about you, Scott, is that you have a very level-headed approach to investing compared to a lot of other real estate investors out there. Now, I'm probably going to offend some people with what I'm about to say, but there's a lot of real estate investors who you say the word index funds, or you say any other asset class besides real estate, and they just want to put you to the gallows. They're like, why would I bother investing in index funds? Like I can get 30% returns in real estate. It's so much better, yada, yada, yada. But you have this hybrid approach. Like everything is so calculated. Everything is just so level with you. How do you think about your asset allocation? Like what are you very specific? I want this amount of exposure to real estate. I know you mentioned that at the beginning. You're also pouring money into index funds. Do you have a strategy? Like I want to be 50% real estate, 45% index funds, 5% cash. Is it something like that? Or how do you go about your allocation percentages?
It's evolved over time, and I think I will always tweak and experiment. But the core of my portfolio is index funds, not real estate. So I've put much more dollars that I've earned and saved into index funds than I've put into real estate. My real estate equity position is roughly comparable to my index funds. So if you said excluding your house and your emergency fund, I'm about half and half real estate and stocks. Now, I experimented with private lending over the last year. So I have a percentage of my wealth, let's call it 15, 20% in private notes. They pay a ton of interest, like 13 to 14% blended rate, because I'm lending to fix and flippers. And that's wonderful, except I'm in a high income tax bracket because my job at BiggerPockets. So I'm paying a very high income tax rate on those notes. That was wonderful because it's like, oh, okay, this is how I could, if I ever wanted just pure play cash flow, I can just like shift some of my wealth into these notes and begin earning a high interest that, you know, I can count on to pay the bills. So the experiment was effective for me and just kind of like, okay, I'm realizing this income, I'm paying tax on it, it's inefficient, but we're going to do that. When those notes mature, I will move them into this real estate investment that I was talking about for the back half of this year and add that to the liquidity position I'm amassing for that. So to your answer to your question, I expect to exit 2024 at this point with half of my equity wealth in real estate and the other half in boring long-term Denver rental properties, lightly levered, and index funds, except for my house and my emergency reserve.
I was pretty close.
Yeah. It's roughly 50-50. I could have just avoided all that time that we just wasted here for me explaining my position. But the way, it's more to that, and it's not any more than that.
This may seem like a very specific kind of random question, but you brought up like, you know, private lending. And so for those who, because we've had other people on the show talking about hard money loans and private lending. And as we've seen, you know, the interest rates that a normal consumer would have to pay go up, how has that also kind of translated over to that area? And maybe for those who are listening, if they haven't heard anything in a while, like you just threw out kind of 13, 15%, like over the last few years, how have you seen that move as far as the percentages that you could expect to earn if you were somebody who did have a large cash position that they could maybe, you know, turn over and start to do some of this private lending?
So I have 1.5 years experience in this. And so I will not pretend like I have like a long viewpoint on that particular item. I'd guess probably not too much of a change, frankly. But what my rationale was, okay, I want to earn income. If in my worst case scenario, I'm foreclosing on a property that has been badly managed by somebody, and I will have a very miserable 3-month to 6-month finish the job project that will be expensive, but I'll also own this asset at 70% of its market value plus another 10% to finish, you know, whatever. So, you know, like, okay, would I pay cash for this property at 70 to 90% of its value? Yes, I would today. And like market could always crash and be underwater or, you know, lose some of the principal. But if I got the property for free in cash today, I'd be happy about it at 90% of its market value. So that was my mentality on it. And I thought there's a reasonable safety to it. And I've had no issues with that so far, but it's a very small sample size. And I hear that the foreclosure rate for a lot of hard money lenders is less than 1% in the last couple of years. So that could change, you know, if prices fall to a large degree, but and it probably depends on some of the hard money lenders out there as well. So,
well,
I don't think it's that safe of an investment. I think that that's a function of the market going up so much over the last couple of years. But yeah,
that is totally fair and a valid point. Even though you've only had 1.5 years of experience in private lending, I think you sit in an interesting position where you get to see all of these different facets, all these different verticals of real estate where people are making money. So you can take either side of this and run with it. I want to do both though. I want to hear some of the newer good strategies that you're seeing out there with, interest rates are changing, laws are changing. You see people talk about there's like sub two, people do Airbnb arbitrage, people do all these different strategies. What are some of the good ones that you're seeing out there that are becoming more popular? And then, or we can start on the flip side. What are some of the bad strategies that you think are going to fizzle out and people are going to really get burned because they've been trying these maybe, newer strategies or newer types of financing or newer ways to crush deals that might not be successful in the long run?
Yeah, I think there's always like a new tool or strategy that begins getting a lot of attention. And
Yes.
it's kind of interesting because like I hope that at Bigger Pockets, I see, and what we're attempting to do is represent a lot of these different strategies. The ones that have these like very flashy outcomes go viral and get a lot of attention. So they get a disproportionate amount of attention, though they're not getting a disproportionate share of voice, if you will, from the content feeds there. And so what that leads to is like over the years, like certain strategies like short-term rentals, for example, explode in popularity, wax and wane. And there's like a weird kind of pendulum for sentiment around short-term rental has been a very viable way to increase your income on a rental property or on a property you own, second home, whatever, for decades, right? This is nothing new. Airbnb has made it a little bit more accessible and easy for a lot of folks. But I would say that exploded in popularity a few years ago. Then there was a panic about whether there's going to be an Airbnb bust. And neither the good promises about short-term rentals nor the bust and doomsday predictions have ended up being true. Short-term rental operators, if they were any good, probably eked out a significantly higher cash flow than they would have if they had gone from a long-term rental perspective. And net of everything, they're probably doing okay from an appreciation standpoint. And it's been if you're willing to do more work and build the systems, a way to slightly increase cash flow or maybe even meaningfully increase cash flow on a rental property. So it's kind of just funny seeing those things like what's working, what's not working. Well, short-term rental has worked, will work, and did work. I guess it has worked and did work, just the same thing twice. But over this entire time period, and it's a viable strategy. I think that there was like a big hype around midterm rentals as well, right? So, that's an interesting one. I love that as a new tool that's gone in there for furnished rentals. I think that the demand for that surged post-pandemic, and that will begin to settle. That's an easy one to convert back to long-term rentals, and it's just an opportunity to earn a little bit more there. I think that there was a big one of the ones that will be problematic and there will be lasting pain for many years is going to be in the commercial real estate space. So this concept of investing with other people's money, and specifically in the form of pooling capital into private equity real estate funds and or syndications, became popular. And a lot of folks doubled the penny 6 times in a row, and just raised more and more and more and more and more and more and more capital, buying all the way through the peak in 2021 and maybe even to the first part of 2022. And those deals are getting wrecked right now. We're seeing asset values in the multifamily space nationwide down 30% from their peak in 2021, because of the rising interest rate environment. So if you bought a property with a 30% down payment and 70% debt, you've completely wiped out your asset value on that deal. It's 100% loss for equity shareholders. And that is the reality of a lot of these deals right now. Some of them are making headlines because they've actively been foreclosed on. Others don't have the debt payment due until 2027 or something like that. So while the equity is zero, if they were to sell today, that doesn't quite have to be reported to the investors, right? Hey, the property we bought it for $100 million. It's now worth 70. No one's going to say that. They're going to say we bought the property for $100 million, and last year it generated this cash flow, right? Close to projections. So that hasn't been communicated to everybody, but it will be over time because that dynamic's not going anywhere. They're not getting helped out from supply, and we're going to continue to there's tons of supply coming online, and all that new inventory is going to keep rents depressed, or not growing in line with what folks need to combat the increase in interest rates. And for complicated reasons, I'm happy to get into if you'd like. I don't expect interest rates or borrowing costs for multifamily and commercial real estate properties to decline, even though the Fed will likely reduce rates. So I think that asset class is in deep, deep trouble, starting with multifamily, followed by office. Office is in a lot of world of hurt, but everyone knew and expected office to be in a world of hurt for all this time. Multifamily's pressures, I think, are a lot more of a surprise to folks. At least who've been thinking about this from a 5-year look back. So how about that? Any other areas that I should dive into for
Well,
real estate themes?
I'm curious because like off of something you said there, you talked about like pressure with the actual rent rates, like the rates that people are going to be expecting to pay with like new stuff coming online. As let's say we're coming into the summer and people have leases that are coming up. Like, what should they expect? Should they expect like it's another year inflation where we get to raise these rents even more, or is it like no, we kind of like push things to the limit, and now because of X, Y, and Z, we're actually going to start probably seeing people pull back on rent because it's getting too competitive.
I think it's going to be market to. If I had to guess, I'd say market rents will be plus or minus 2% nationwide. We're not going to see U.S. rents collapse like across the nation. You're going to see tremendous regional volatility in rents, however. For example, in Austin, Texas, they are building, let me pull it up here. Let me take a quick edit break and I'll pull up this data for you.
Perfect.
In Austin, Texas, where am I here?
This is great because I manage a property in Austin, so this is perfect.
Okay. All right. So for example, in Austin, Texas, they will deliver 26,948 new multifamily units.
Wow.
That is 9.5% of existing stock, an enormous increase. And this is all data from Yardi. You can go see the report there. You just Google the Yardi, I think, forecasted supply growth of multifamily properties. So that's a nearly 10% increase in number of units. So I don't care how great Austin, Texas is. I know people have great things to say about it. It's a wonderful place to live, right? That's why they're building so much inventory, is because they expect all these people to move there. Ain't going to happen where you're going to see rent increase in Austin, Texas this year, unless I'm very mistaken about something. Or there's a huge surge in inbound migration this year, not whatever happened last year or the year before, this year, because that is an immense amount of inventory. Now, there's 1.2 million total units under construction. Not all of those will get built, but 500,000 will get delivered in 2024. Remember, this takes time for these units to move through. That is the most ever. And so that will impact things around the country, but it will particularly impact places like Austin, Texas, that have that huge supply growth. So other big metros that are going to get hit, Miami is going to have 6.4% increase to existing rental stock. Dallas is going to see 4.5%. Charlotte, North Carolina is going to be 7.2%. Orlando, Florida, 4.4%. Raleigh, North Carolina, 8.1%. Denver, 5.3%. I won't keep going, but you get the picture. Some of those metros are going to be really heavily impacted. While places like Chicago, with less than 2% increase in new units, are going to be relatively unaffected, would be my guess.
Interesting. And you said that's Yardi, Yardi?
Yes.
Okay, people can go check that out. And we'll definitely link it up in the show notes as well. Something else interesting that you said is you think that commercial rates, I think you said specifically, you think they're going to be unaffected even as the Fed continues to cut rates. Why is that?
So in the commercial real estate world, the most important, I think, benchmark, if you will, is going to be the 10-year U.S. Treasury yield. The 10-year, there's normally what's called a yield curve, right? So the federal funds rate will be, 5.25 right now. So in a normalized yield curve environment, people want more yield for longer term debt, right? They're taking on more risk, right, about future state volatility. Right now we're in an inverted yield curve, which means that the 10-year rate is roughly at like 4.25. So it's actually 100 basis points lower than the Fed funds or overnight Treasury rate. Well, if you were to normalize it, if you said rates were never going to move again, and we're just going to sit here for the next 10 years, the yield curve would normalize, and the 10-year would be 150 basis points higher than the federal funds rate. So that leads to a 10-year yield of, what is that, 6.75%, right? Commercial real estate debt, and specifically multifamily debt, usually trades at a spread, or almost always trades at a spread to the 10-year Treasury rate. And again, a key benchmark for this. And those notes are typically backed by Freddie Mac, right? Freddie Mac is a government-sponsored entity. It purchases mortgages from apartment complexes. So most small, like if you want to buy a $10 million apartment complex with a $6 million loan, right? You're going to go to your local bank and they're going to make sure you meet Freddie Mac guidelines, these very specific guidelines, just like a home mortgage. And then if you qualify for those, they will underwrite the loan and then they'll sell it either to another bank or to Freddie Mac, right? And that's how they get liquidity to the next loan and the next loan on that. So because of that, they spread, again, they trade against a spread to the 10-year. If the Fed lowers rates from 5.25 to 4.5, which is what they're saying they're going to do, the 10-year would settle at 6%, not 4.25. So if you're thinking that the 10-year rate is going to stay the same, which means that the borrowing cost for a Freddie Mac loan would stay the same as it is right now, you are essentially making a bet, in my view, that the Fed is going to lower rates 10 times to get to about 2.25, or 2.5% to 2.5 to 2.75%. That's 9 rate cuts from today at 25 bips a rate quit. And that means that your borrowing cost for the 10-year, and then therefore your spread to commercial real estate, will be the same as it is today. I think that's a crazy bet, right? A lot of people are taking that bet right now, but I think it's absolutely bonkers. Like, think about the extraordinary set of economic events that will have to occur for the Fed to lower rates 9 times and in a hurry. And if that situation unfolds, the value of your multifamily asset ain't going up during that same time period. So that's where I'm like very afraid for this asset class, is both that supply growth that's coming online and that interest rate dynamic on there. Now, plenty of people disagree with me, but that's my take. How'd I do there? Very nerdy subject. Hopefully
crushed
got it
it.
across.
That's why you're CEO BiggerPockets, Scott.
So I'm afraid in that space.
Well, now that we're kind of diving into some of these things, maybe people are reading some headlines, maybe they're, reading some things that don't jive with what you think. I'm just kind of curious because I don't feel like I get too many headlines that come across onto my phones about real estate or realtors or whatever. But that was the one that came through, and I just kept getting like article after article, like fed to me, is about these laws changing on realtor fees. Is that something that's just clickbait and doesn't really matter, or do you see that actually driving real change and when people are going to make deals over the next, year into the future?
I think it's a big item for certain companies in this space, right? Brokerages, they got to think about that. But for the average home buyer or real estate investor, you're talking about 2 to 3% of the total purchase price. And whether that goes away or stays the same, it's 2 to 3% of the overall decision-making process. So I think that real estate investors will largely find, like, the journey is not going to change for a real estate investor or a home buyer, right? Someone has to figure out what they want, right? Like, what is the buy box? If you're a real estate investor, what kind of home do you want, right? What's a good deal? Where should you look? What's a bad deal? How do you actually submit mechanically an offer to someone to buy their property? How do you meet all those timetables? How do you mechanically close the transaction and negotiate and meet inspection deadlines and those types of things that will not change, for example, around the buying process? And then if you need them, are there resources to help you furnish the place or do any contract work, those kinds of things? So those jobs need to get done. A buyer agent is probably best equipped to do those jobs. Whether they get paid less to do those jobs or paid the same by some buyers, I think remains to be seen. But I think a lot of speculation is happening right now, and I don't think that the fundamentals of it will change. If anything, we might see some change in buy-side commissions for some types of deals there. I think it's a really big deal if you're Keller Williams or you're Remax or you're Zillow. Then there's lots of things to think about.
And for those who aren't familiar with like the articles I'm talking about, like in your opinion, what has actually changed? Like what was the change in the law or the rules or that the realtor group agreed to?
Yeah, well, the National Association of Realtors and several related large brokerage firms were accused of conspiring to set commissions in a standardized format, right? To a monopoly around that. A jury, and I'm paraphrasing a little bit here, in 2023 convicted on those items. And so the NAR, the news from March 2024 is that NAR agreed to a settlement, presumably for damages related to that ruling. So as part of that, the big change that I think people are getting worked up about is when you buy a house today from an MLS system, whatever the agent that you're working with will see in the description on an MLS page listing the commission that the seller is offering to that agent. So that is in a remarkably tight band in Denver, Colorado, for example. I'm not going to go further into the opinion side of that right now because it'll get people get very worked up about it. And the theory is that will not be a very tight band in the future, or some people think that there will not be that as tight a band as some sellers say, no, we're not going to offer a buy-side commission. You want to buy this property? You can either represent yourself or you can pay your buyer agent directly for that. So the theory is there that if buyers are paying out of their pocket and feeling the cost of paying that buy-side commission, like feeling it because of the new changes, they may not have felt it before because it's financed into the mortgage and it's just always been that way, that kind of stuff. But if they're the one negotiating and paying that they might pay less to some of those buyer brokers, especially in different types of properties, really high price properties, for example, one theory. So that's I think what's got everyone in a hype here. And it's, the agent commission market is a very big economic prize in this country. $80 billion in agent commissions are generated on an annualized basis, waxes and wanes with the market, of course, but on average, $80 billion. And so that's a big cookie jar that everyone has got their hands in across the gamut, from big brokerages to lead sites like Zillow to 1 million agents, 1.4 million agents. So it's potentially threatening some folks' way of life. But again, the job to be done in buying a home does not change. Perhaps, maybe the pricing of that job to be done will change, in my view.
Staying on these macro trends, do anything in the AI or blockchain arenas either excite you or kind of scare you a little bit? Because there's a lot of talk around realtors are going to get replaced with AI and houses are going to be bought with smart contracts in the future on the blockchain. You hear all these different ideas. Do you think any of these actually have some grounds? And are these things actually going to happen? Do any of these things excite you? Do any of these things scare you?
AI. My overall view on AI is that AI, and again, I could be completely wrong on this. I'm not an expert on AI. I just look at it as like it's like the internet, right? Like Gmail, right? Everyone uses Gmail. It is obviously helpful to use Gmail or whatever email server you use, but like it's one of these, everyone uses it. It's a tool you have to be comfortable with and use as part of your life. And not using it will give you a huge long-term disadvantage. But essentially, as it becomes more accessible, everyone is going to use it, and it's just going to be part of life for it. So I'm not changing anything about how I behave or react as part of that. I just think it will generally enhance productivity for humans and be a general boost on that front. I don't see it being a game changer in real estate transactions in the near term. Maybe in some automation of managing systems, if you have a big business, or managing like a flipping process, for example, you can see some automation gains there. But I don't think like the home buyer who's buying one property every 10 years is going to want to automate much of that process. They're going to want to understand most of those things, and it's going to be a high stakes decision every time. So that's my view on AI and real estate specifically. And blockchain, I can get into a whole thing for blockchain, but the blockchain technology, at least as it was built for the Bitcoin application, is only valuable for the Bitcoin application, as I understand it. It's the proof of work concept relies on computing power, and so like unless you want to build for some reason a trustless system for understanding title across the country, I think you're going to and devote a tremendous amount of processing power to a decentralized network to use proof of work. If you want to get into it on this, I don't think blockchain is going to be a big use case in real estate. I think you're going to see trusted companies managing chain of title down the stream. But I could be wrong on that. I'm sure I've got some people mad about the applications of blockchain technology. I think that if there's an application for blockchain technology long term, it's the Bitcoin maximalist one of it. securing the Bitcoin network.
Well, I love diving into all these different technical topics, and I'm sure there's probably a good chance we'll get into some more. But one kind of more personal, like, a little less technical change that you've had is you're a dad now. Like, how does that change some of the decisions that you're making? And maybe for those investors who are out there who aren't there yet, like, what are some things that maybe they should kind of expect? Like, you probably didn't think about this. This is probably not top of mind, but now, man, since I've become a dad, this has completely changed the way I look at things.
Yeah, I think that for some people, it's like, oh, my whole world is different. It's like, no, I have this wonderful baby that I love spending all this time with that's different, but I'm still, running this company, enjoying what I do, working hard in my career, trying to stay fit, starting to hang out with my friends and family. It's just magical every night hanging out with my little baby and her just crawling all over the place, playing, cuddling, all that kind of stuff. I would say the biggest shift is a more subtle one of like, I spent 10 years, like 20, from 23 to 32, was that 9 years, just basically in the pursuit of optimization to, build a legacy, build wealth for future Scott. And I'm like, whatever I'm waiting for at that point, like I've turned that corner and like that future is here. Like I want to spend that time now where I can with my little one, not spend the extra 40 hours a week trying to get ahead like I perhaps used to for that. That's the biggest, I think, shift overall. For having a baby is just like easing back on like, okay, I'm going to be very efficient with my day job, but like I'm not going to be. I don't know if this is you, Cody. And working the third business idea this year on the side here.
You're not
I'm just
wrong.
going to be running my passive business because I got more important stuff to do now. I got a little one to hang out with. So that's the big shift, I think.
Are you doing any of these? You're, like you just said, you're an efficient guy. You always are taking the best route in your mind. What are you doing on the setting your daughter up front? Are you doing the buy her a rental property so by the time she's ready for college, it's going to be paid off and she can sell it and fund college that way? Are you doing the 529 route, the Roth IRA, and she's like a model for the business, or what's your plan there? Or maybe you're letting her rough it. Maybe you're like, no, I'm not giving her any money. She can figure it out.
So I think I'm like it seems like there's no right answer, but a lot of strong opinions on whether you should make your kid really rich. I basically have several paths I can take right now, right? One is like, I can just start moving the maximum allowable gift to my daughter every year in very tax efficient ways and investing it on her behalf so that she has a high probability of being a millionaire several times over by the time she's 18 or 21, right? I have the path of giving her nothing and letting her kind of figure it out on her own on that front. And there are very strong convictions on both sides of that and everything in between. My approach, I think the one thing I'm sure of is that I'm going to pay for education. I had my college education paid for. And while some people believe in having folks figure that out, that's just not how it happened for me. And I'm going to provide that. That said, I'm making a long-term bet that the best thing I can do is build my general wealth and then use that to fuel education costs with a little bit of a caveat. I am going to maximize the 529 plan this year contribution. And I have a matching program through Colorado that I'll take the match on for that. I am a skeptic that college prices, I may be completely wrong on this. We'll see. Laugh at me in 15 years. I think college prices are coming down in this country. I think that the education system is in a death spiral right now in many parts of the country, and that it's going to implode and it's going to emerge from the wreckage in a much better place. And I think a big part of that has to do with the student loan programs we set up here in the United States and how many of them are funding ROI negative college degrees. Not all colleges ROI negative. Some degrees are, about 35 to 40% if you believe the free op study, which you can get into 30,000 college degrees and the ROI that these folks very masterfully, I think, estimated. And I think that is going to change. And once you stop financing that with federally insured student loans, which I think is, so anyways, I have a very complicated set of bets here around like, I don't think college education is ROI positive, and something is going to emerge as a catalyst to remove the parts that aren't ROI positive, and that's going to lower costs in a real sense. If I'm wrong on that, I'll have enough wealth by the time my daughter is of college age to fund it with after-tax cash flows. If I'm right about that, then I won't have over saved for college with a 529 vehicle, which can be difficult to harvest. So how's that for philosophy and then practical for what I'm doing for college education?
It's perfect.
I think it's a great answer. And I mean, I completely agree with you as far as the standpoint of like something's got to change. I mean, in what other world would you sit there and loan, an 18-year-old this very large sum of money for with no clear indication that they could ever financially pay it back or that it makes any investment sense? Like, we don't do that anywhere else, and it obviously is not working. And it allows the colleges to kind of have like to charge whatever they want to charge because the kids aren't having to pay for it anyway, and they can get the money so easy. And you start making that money a little harder to get, and that trickles down. So
there's all that. They're saying that like the market can stay irrational longer than you can remain solvent. So I could definitely be wrong, and it 20 years still hasn't solved that problem. But I think change is brewing.
Well, you've been in the seat for quite a while at BiggerPockets, and there's probably a ton of people on our podcast who are very familiar with BiggerPockets, but at the same time, it's grown so much, and it's like there's so many different areas in which it reaches out into. There's the publishing arm, and there's the classic forums. But what are maybe some of the things that you guys have been working on more recently, offerings that you have that you haven't always had, or just things where you feel like a lot of the audience out there maybe has put BiggerPockets into this one category or silo and don't realize how much more it has to offer?
Yeah, well, the thing that we've been really most focused on the last couple of years is building out first a network of investor-friendly real estate agents, and then the last 3 years we've been focusing on building an infrastructure for investor-friendly professionals of all different types. So we've evolved that offering to have investor-friendly lenders, whether you want a conventional QM or non-QM mortgage or hard money. We just launched a tax professional finder here in mid-March 2024, and we launched a property manager finder in May of 2024. And in the next year, we'll begin seeding and launching marketplaces to help you find investor-friendly lawyers, contractors across a large number of disciplines, those kinds of things. So that's been really the big project: is what can we do that very few or nobody else can really ever offer? It's the investor-friendly professional. And we have a huge network. A lot of these professionals are just like, I want to invest in real estate and have their own portfolio, in addition to having this small business or professional job of providing these services. So that's been our big project. And it's been a lot of work because a lot of different things have to go into a program like that. But that's been very successful for us and seems to be helping some folks.
Exciting stuff. We will definitely get the link from you and link that up in the show notes. But for those who want to continue on the Scott train and hear more about you and what you have going on personally and maybe connect with you on socials, where do you want to send people? Where is the best place for people to get more Scott?
Yeah, you can always message me on BiggerPockets. I got an account there. Just Google Scott Trench BiggerPockets. And I also, you can listen to me twice a week on the BiggerPockets Money podcast, which is where I talk about the slow and steady compounding journey that I've been on and why the merits that I think it has on there. So personal finance and a little bit of real estate sprinkled in there.
Well, thank you so much, Scott. You obviously have a ton going on, and you got a new family going on. You got a new house going on, but you took the time out to give our audience some more information. We're very lucky to have you back on the show. So thank you again for giving us some time.
Thank you both for having me on.